So we're going to be working on the Locator Cashflow project. If you haven't already read the story in your booklet, you need to do that first and then come back. So what do we have? We have a client who's very agitated because they had a business plan that was going to generate $26,000 a month, as you can see from their initial budget. And it's not generating $26,000. Let's go to the checkbook. At the end of 2 months, they have $11 in the checkbook. What's worse is they have $11 in the checkbook after putting another $29,000 in. $8,000 in January and $21,000 in February. So they are concerned that this product is a dog, it's not feasible, that they were lied to, that's never going to make $26,000 a month, and that should they just abandon this, or is it going to bear fruit? And they want to know quick because they're very, very concerned. On the input tab, you have the initial assumptions that were used to make that initial budget. You have the first 2 months of checkbook activity, and then you have the first month of sales activity here. All right, so let's start working on that. The first thing we're going to do is compare the initial monthly budget to what the budget should look like at the number of units they sold. Let's do that. So I'm going to point, for all my cells, I'm going to point back to either the client's actual data or the assumptions in the budget. So let's point to how many they actually did sell. So let's scroll down. How many did they sell? 202. Okay, we'll be using that. Okay, so we have both hardware, which is the first line, and software, which is the monitoring. These locators have GPS in them, and they're put around whatever the valuable thing is that the clients want to monitor. Cattle, artwork, vehicles, whatever it is. So what should this budget have been at 202 units? So the sales price of the hardware is $230. The monthly charge for the monitoring for 202. And since that's the annual subscription fee, we need to divide by the 12. So now the cost of 202 units. Let's look at that for a minute. What did they pay? 1,000 cost them 55,000, and the original thought was $55, so they're paying exactly the original budget. That's interesting. Okay, 202 at costing 55 each. All right, epoxy and cell phone service. So 202 times, what should the budget have been? Epoxy, $5. Telephone service for 202. $8 a piece. Occupancy cost is a fixed cost. It's not based on how many units. It's just per month. You can see there's going to be several fixed costs. Packing and shipping is variable. So 202 units times packing and shipping, $9 a piece. Dealer commission is based on the hardware sales. It's 15%. Depreciation is based on the Larry bought assets for the business. Let's calculate that differently. Larry bought assets for the business, and they have a useful life. So you can see what I did there. Larry actually bought the assets and contributed them in. He does, though, expect to be repaid, so it wasn't a capital contribution, it was a loan to the business when he put those into the business. Okay, and then warranty costs are based on the hardware, and it's a % of sales. All right, then operating profit would be the first two lines minus the sum of all of your expenses. And then interest will be based on the loaned assets. And put some parentheses in here. There we go. Okay, and then your profit's going to be your profit before interest, your operating profit. We're not going. He's a sole proprietor, so we don't have any taxes to worry with. Okay, great. Get some nice formatting in here. So now we can put in the monthly actual. I'm just going to copy this over to get the formatting so I don't have to read bold and center. So they actually did sell 102. So what did they get for those locators? So let's look here. In February, they got the cash from the sales from the January locators, and they got the cash from the subscriptions from January. So in the initial budget, they got that. It's net of the dealer commission. So the dealer didn't give them 100% and then send them a bill for the 15%. They just remitted the 85%. So let's divide that by 1 minus the commission rate. All right, and then the initial subscriptions we're going to divide by 12 because we just need 1 month's worth. So it looks like the sales price, and we could have seen that from looking here, the sales price, you can see everybody was billed $230, so there is no sales price variance, but it doesn't look like they got the monitoring revenue that they thought. Okay, cost of goods sold, we already looked to see that it was exactly the 55, so we're good there. Epoxy, let's see, what did they end up paying for epoxy? Okay, so they put the epoxy packing and shipping on the American Express. Okay, so we don't have any details to break that out, so let's combine it on our spreadsheet here. So let's take packing and shipping, put it up here. That's not what I wanted to do. So, there we go. And now we can point to our checkbook. And we're going to put minus instead of plus, since it's negative in the checkbook. Okay. Cell phone service, 202 times. What did they pay? Let's look at that. Cell phone service, 202 locators. Okay, so we can just point to that. We're going to do negatives so that we get a positive number. Occupancy costs, let's go look. Yes, they paid the rent in January. Website monitoring and customer support. So this is just in the payroll. This payroll that they pay twice a month, January and February. Can you see it's the same? So the payroll covers both of those. So we'll put another subtotal in here. And we'll put January's payroll in there. Okay. Dealer commission, that times the 15%. There was no change to the depreciation. Was there any warranty? Didn't pay any warranty costs? I don't see any. Okay. And let's fix this formula, because now we have the subtotals here. So all right. Oh, interest expense, we have to divide that by 12. We just need 1 month of interest expense there. Okay, and now the interest expense for January is going to be a little different because we have to repay Larry for those assets plus the loan that he made in January. All right, and then add that up times the 8%. Divided by 12. Okay, let's look at this for a minute. Larry didn't make $26,000 a month. Well, some of that's not a surprise because he didn't sell 300 units. So what we see here is the profit we would expect at a 202 unit level would be pretty close to $5,000. Now, we're not going to start off by telling Larry, there's no way you're going to make 26 because you're not selling 300 units a month, but you should expect about 15,000 a month. Our client would still be extremely hostile. Why? Because he's not even seeing that, anywhere near that. So we will get around to telling him in the long run we would expect a monthly profit of this if you keep selling 202. But what we have to address is the cash flow problem. He has a cash flow problem. So what we're going to do is we're going to start a new spreadsheet calling it Cashflow. And I'm going to copy these lines over here. I'm not going to use them all, but I'm going to copy them just to reduce the amount of typing that I have to do. Okay, so I'm going to start setting up the cash inflows. And then the outflows. All right, there's no payment for depreciation. These line items are not on the cash flow statement, so we might have so what we're going to do here is we're going to set up a cash flow prediction. And 1 year is probably a pretty good timeline for showing Larry what things look like. So the first two columns here will match the checking account because cash flow is the cash that went in and out of the checking account. Then for March through December, we're going to make reasonable assumptions about what we could expect and see what happens to cash flow because that's Larry's primary concern. So this is the end of this video, and in the next one we'll do the cash flow projection.